The 4 growth ETFs that I'm about to show you have all outperformed the stock market over the past few years, which is even more impressive because the stock market benchmark, referred to as the S&P 500, just continues to break record highs. Now, of course, the past doesn't guarantee the future, and no one knows what could happen in the market, but for this video specifically, I'm going to break down my top 4 growth ETFs into great detail so that by the end of this video, you'll have a much better understanding on what they're composed of and why you may want to consider them. And I will say, if you don't know what ETFs are, they're pretty much a way to buy a variety of different investments that track a particular market segment all within one purchase, where the 4 ETFs that I'm about to show you provide the potential for significant growth while containing much better diversification and reduced risk when compared to picking individual stocks. All in all, just realize that typically investments with a higher potential reward also come with a higher potential risk, so be aware that these investments tend to be more volatile, and please understand that this is not a get-rich-quick overnight type of video. But before we dive into further details, my name is Danny Sully, and all I ask is if you do find value in this video, that you consider hitting the like and subscribe button for future content like this. With that said, let's first go over my personal favorite right now, that is the Schwab US Large Cap Growth ETF with the ticker of SCHG, where popular alternatives you may also consider here would be VUG or QQQ, ideally QQQM for long-term investors. Now, before we dive deeper into the facts here, it's really important to understand that for all the investments I'm about to show you, the order I'm using is based on the percentage of overlap that each ETF has with the S&P 500. And so if you don't know what the S&P 500 is, it's pretty much a way to buy 500 of the largest publicly traded US-based companies, where you probably heard of most of the top companies that are inside of this index, like Nvidia, Apple, and Microsoft, that each have around 6 to 7% of the weight toward the index. Which, being referred to as the stock market benchmark, since 1957, the S&P 500 has delivered an average annual return of 10.56%. But understand that Charles Schwab's ETF SCHG is also made up of large cap companies, but now they are solely the ones that are believed to have more growth potential, and that is exactly why SCHG seeks to track the Dow Jones US Large Cap Growth Total Stock Market Index, where the fund was created in December of 2009, and instead of 500 companies that are in the S&P 500, SCHG currently has 198 holdings. Now, if we look at this image, you can see that the top 3 companies that are in this fund are also Nvidia, Apple, and Microsoft, but now they have around 8 to 11% of weight, which is a little bit more than what was in the S&P 500, that was about 6 to 7%. So because of that, if we were to add up the top 10 holdings, they actually make up roughly 58% of the entire fund, and that is also why technology is the largest sector in this fund, where it carries about roughly 48% of the weight alone into that one sector. Aside from that, another nice perk about SCHG is that it has a low dividend yield of 0.36% over the trailing 12 months, and that's really nice to know because if you are investing over the long term in a taxable brokerage account, dividends are taxed regardless on if you reinvest them or not, and that can lead to what's called tax drag, which can quietly eat away at your potential growth over time. And yet alone, growth investments, which is why they are named growth, typically outperform dividend ones over time because they tend to use their profits to continuously reinvest back into the business for further growth. And so because tax efficiency is especially crucial when you are investing in a normal taxable brokerage account, which by the way can be extremely powerful if you invest into it properly, but just know that SCHG from the year of 2024 generated 99.99% of qualified dividends, which means that the low income that you would have generated if you held onto the investment long enough, that could also be taxed at the long-term capital gains tax rates, which are much more favorable. But aside from that, SCHG also has $53 billion in assets under its management. But another great thing to know about SCHG is that it has a 0.04% expense ratio, which means for every $10,000 that you invest, you would be paying $4 per year in fees, which is literally nothing. And don't forget that the expense ratio is automatically taken out of your investment over time. It's not something that you have to pay separately. After that, we then have the amount of overlap with the S&P 500, where SCHG currently has a 55% overlap. Besides that, if we were to look at the performance for SCHG over the past 10 years, the fund is calculated to have a Sharpe ratio of 0.93, which pretty much shows how much return the investment has provided per unit of risk that is taken, which this is a nice metric to see, especially if you compare to other ETFs like the S&P 500s that was 0.85. But aside from that, SCHG has a 17.77% standard deviation over the past 10 years when compared to the S&P 500 that was 15.14. And then if we look at the fund's best year that it's had in the past 10 years, it was up 50.11% in one of the years. Then the worst year was down 31.8%, which does show that if we compared that to the S&P 500, that there is much more volatility here than buying the S&P 500. But knowing that, SCHG has grown 18.51% over the past year. Over the past 3, it has averaged 29.95%. Over the past 5, it has averaged 16.88%. And if we look at the past 10 years, with the strong market we've had, SCHG has averaged 17.94%. Where if we were to compare that to the S&P 500 over the same period, the S&P 500 has grown 14.58% instead, and so averaging over 3% more of growth per year over an entire decade can definitely end up making a big difference. In fact, if you had $100,000 invested in SCHG for the past 10 years, you would now have roughly $520,000, where if that were the S&P 500, then you would now have roughly $390,000 instead. But knowing that about SCHG, let's now go over the number 2 growth ETF, that is the Vanguard Information Technology ETF with the ticker of VGT. Now this one, as the name implies, is a sector ETF that is based on technology stocks, and although it's not tailored for only growth tech stocks, I'm including it in this video because I view there to be a ton of potential in the technology sector, especially long term with how the world is advancing. But to start this off, VGT tracks the MSCI US Investable Market Infotech 2550 Index, where the fund initially launched in the year of 2004, and it currently has 322 holdings in the fund, where the top ones here are Apple, Nvidia, and Microsoft, that are heavily weighted in the fund, from each having about 12 to 16% of the weight toward the fund. And so if we look even further into this, you can see that the top technology sectors in this fund include semiconductors, system software, technology hardware, and applications software. Now this fund currently has 98% into technology, where over the trailing 12 months, it's provided a 0.4% dividend yield. And do know that it provides the opportunity for 100% qualified dividends. It also has a total of $112 billion in assets under management, a 0.09% expense ratio, where there is a 34% overlap by weight with the S&P 500. Besides that, also know that VGT computed a Sharpe ratio of 0.97, a standard deviation of 19.88%, where its best year over the past 10 years was 52.65%, and the worst year was down 29.7%. And then when we look at the past year, the fund has grown at 21.46%. Over the past 3, it averaged 30.17%. The past 5 averaged was 18.36%, and over the past 10 years, VGT averaged 22.18%. All in all, if you believe in technology stocks long term, this could be a solid option to consider, but also be aware of the additional risk and that this is solely a sector ETF and that no one knows what's going to happen in the future. But moving on from VGT, the number 3 growth ETF on my list that I'm really starting to like is the Invesco S&P 500 Momentum ETF with the ticker of SPMO. Now this one is really interesting because it is based on the S&P Momentum Index that tracks the performance of stocks in the S&P 500 that have a high momentum score. And so the fund rebalances twice a year in March and September, and the companies are weighted based on their market cap and their momentum score. And so with this fund, it launched in October of 2015. There is a total of 100 holdings, where the leading ones are Broadcom, Nvidia, Meta, JP Morgan, Palantir, and many others that aren't always at the top in other growth funds. And so because of that, if we were to add up the top 10 holdings here, they make up roughly 52% of the entire fund. On top of that, the fund is reported to have about 35% of the weight in the technology sector. It computed a 0.65% dividend yield over the trailing 12 months. Historically, it has computed about 95% or higher in qualified dividends. The fund is a bit smaller than the other ones in this video, where it currently has about $13 billion in assets under its management. It also has a 30% overlap by weight with the S&P 500, a Sharpe ratio of 0.99, and then a standard deviation of 16.17%, which if we look at the best year that it's had from the past 10 years, it computed to be up 45.81% when compared to the worst year that was down at 10.46%. And then over the past year, the fund has grown at 25.05%. The past 3, it has averaged 28.24%. The past 5, it averaged 19.83%. And then if we look at the past 10, it averaged 17.93%. Needless to say, this has outperformed the S&P 500. The volatility barely increased, and the worst year was down less, being down 10%, rather than the S&P 500's worst year that was down 18%. But if you don't like SPMO, the last one on my list, the number 4 growth ETF, is the VanEck Semiconductor ETF with the ticker of SMH. Now, as the name implies, this fund is also a sector ETF that is based solely on semiconductor stocks, which are the center of technology and geopolitics, where in the current moment, billions of semiconductors are working to power your devices, store data, and keep you connected to the world digitally. All in all, semiconductors have become a key role in the global economy, and because of their impact, understand that this sector is highly cyclical because of potential supply and demand imbalances and geopolitical factors like trade policies. But rather than buying just one stock like Nvidia, SMH tracks the MVIS US listed Semiconductor 25 Index that currently has 26 holdings, which is crucial to understand because it still has a high weight to companies like Nvidia, where you can see is 20%. 10% is then exposed to the Taiwan Semiconductor Company, and right after that is Broadcom. Crazy enough, the top 10 holdings make up roughly 77% of the entire fund, so this by far has the least amount of diversification compared to the other ETFs I mentioned, and is why you need to be even more careful on how much you allocate based on that. But before diving further, this fund was created in December of 2011. It is 100% in the technology sector. It paid a 0.3% dividend yield over the trailing 12 months, which it also computed to offer a potential of 100% qualified dividends. The fund also has $37 billion in assets under its management. It's also the highest expense of all the ETFs in this video, with a 0.35% annual expense, the expense ratio. And then it has the lowest overlap with the S&P 500 by its weight, that is 14%. And it has the highest Sharpe ratio that was computed to be 1.09, with a standard deviation that is by far the highest at 26.39%, where the best year over the past 10 years was up 73.37%, and the worst year was down 33.52%. And then if we look at the past year, SMH has grown 46.11%. Over the past 3, it has averaged 46.78%. The past 5-year average was 28.43%, and over the past 10 years, SMH has averaged an annual return of 30.29%. To sum it up, if you believe in semiconductors advancing over time and driving innovation in the modern world, and that even with their high levels, there is still plenty of potential to come, this may be a solid option to consider, but be aware of it having the most volatility and is likely the riskiest of all the ETFs I just mentioned. Now, I will add that I plugged in all these ETFs into a simple 4-fund portfolio that consists of 40% SCHG, 20% SMH, 20% SPMO, and 20% VGT, just to give a simple example of data metrics from StockRover, which if you want to check it out yourself, you can get a 14-day free trial using our link in the description below. But from this simple 4-fund portfolio that is extremely aggressive for growth, this portfolio would have grown 560% over the past 10 years, where the S&P 500 would have grown at 300%, so that's almost double the amount of growth. Now, like I said, no one knows what the future holds, and you do have to make your own financial decisions, but I will say, because you've stayed this long into the video, I have created an entire index fund cheat sheet that simply shows all the data for each of these ETFs, as well as many other top ETFs that you may really want to know about and consider yourself. Which, while you're at it, if you want to start investing on a new platform or check out other top financial products or free resources that we've created, I'll have direct links in the description below for you. At the end of the day, our mission at InvestLane is to help you save and invest wisely to build lasting wealth. So please do whatever you believe is best for your situation. This is not financial advice, and you must do your own research. Which, if you found value in this video, don't forget to hit the like, subscribe, and notifications button for future content like this.